I'm nicely positioned for a comfortable retirement that I hope to start in 4 years. I have a long-term view, in spite of being 56, and I'm a techie at heart, that believes the Internet of Things is going to be a game changer that I really should participate in. For everyone who's listening, the Internet of Things is the idea of a connected world where your thermostat talks to your chip in your clothes, talks to your this, everything's talking to each other. Either of you could come up with a better definition of the Internet of Things, but it's the idea that everything is smart and technology. Yay. Okay. All right. If I carve out $125,000 in my Roth for this, it would represent less than 10% of my total investments. So I see it as a good managed approach to taking on more risk and reward within my total portfolio. David Gardner seems quite supportive of the Internet of Things movement as a place to grow wealth, and I'm thinking he's likely right. So I should hook my cart. Thoughts?
So, of course, I do like and believe in the idea, getting away from phrases, sometimes buzzwords like Internet of Things, and just saying, there will be a chip or should be a chip in almost anything that is consequential. A chip in, certainly our iPhone today. That's Find My iPhone, makes it possible for you and me to do, right through to the table that's there in your corporate staff room so that people who are managing assets, the physical assets on the property, know where the table is. It might sound mundane to put a chip in just a table. At the same time, chips are so cheap, it just makes sense so that you know where everything is. So, less theft, all kinds of implications for this. Chips inside you and me. I will be somebody who's perfectly willing to take the tiny little pinprick incision or whatever to no longer have to keep my driver's license. I would be happy. Not everybody would agree with this, but I would be more than happy to take, my vitals in a tiny little microchip and just have it inserted in, I don't know, let's go with my elbow, so that, I could just slam down my elbow and just make my life easier. Chips in everything. So I think, yes, that's the case. However, I don't think you necessarily should think in terms of, I will allocate 10% of my portfolio to Internet of Things. What I would do is I would say that you should be looking at the next 30 years as an investor and asking, what are the technologies and companies that will get me there? And I would pick ones that you yourself know or feel comfortable with. So you don't have to go out and find which is the next best Internet of Things company when you know that, I don't know, this is a little silly, but Amazon is going to be selling tons of things that have chips in them. And you and I are going to be buying and upgrading our tables, perhaps. Right? So I think that recognizing a trend doesn't mean that you have to latch onto a single company or the one.
The chip company.
Yeah, I think it's more recognizing the importance of that and making sure that you're invested not in Xerox, but in Amazon, as an example. So did that answer that good question? Did I hit it at least half?
Yeah,
I go for the gentleman's C. So if you're telling me that I got a C minus, then I'm really satisfied with that.
No. I think one of the issues that comes to investing in growth stocks is kind of the word, the phrase that people throw around.
I try not to use it.
I know you try not to use it.
That's a hang-up of mine, but keep going.
But the idea that these are stocks that are just going to take off and head into the stratosphere, we all want those stocks. Like, yes, I want the stocks heading to the stratosphere, but there is a certain amount of risk involved with these stocks. And so I guess for our listeners out there who are thinking, okay, yeah, you know what? I want to invest in some really good companies that are going to take off. There's no guarantees that they are. So what's some general advice from you for people who are really new investors, who are really new and are thinking, okay, I want to invest in some quote unquote growth stocks?
Well, I think your first 15 stocks, and I hope you get from zero, if you're at zero today, to 15 as fast as possible. We want our cars to go 0 to 60 in, 5 seconds. I'd like you to, as an investor, to go from 0 to 15 as quickly as possible. And if that means you have $1,500, that means you put $100 in 15 different stocks. And you can do that through things like ShareBuilder or other accounts you can open today. So getting diversification right away, and then make those 15 the 15 that you know best. That's how you should start. And if that means because you love technology or into this, that you start to buy those kinds of companies, great. If not, that's fine too. So for most people, if we're talking about Motley Fool answers, we're talking about one answer to you. How do I get started investing? Start with stuff that you know and love, and make sure that you have a bunch of them, not just a single one. So from there, I think that if you find that you're missing a lot of the key tech trends, I would say really quickly, the internet, virtual reality, and biotech and genomics are three really important trends of our time. History will look back and say this was the era. They won't say we were generation X, Y, or Z. I don't think they'll say we were the internet generation. And that's going to continue to be very vital. So if you find that none of your money is in those three things, I would encourage you to take, let's say, 10% of your growing portfolio and put it there. And have fun. If we're totally wrong, if we blow it, that was only 10% of your portfolio. On the other hand, if you find a company like Netflix or Amazon early on, it'll grow to be a large part of your portfolio in a good way.
And I'll highlight something you said when you first started addressing this question, having the money invested for 30 years. Mm-hmm. So long-term horizon, this is someone who is close to retirement. And some people might think, well, I don't have 30s, but you do. This fellow's in his 50s, 30 years in his 80s. He needs his money to last a long time. So having a portion of your portfolio that you designate as very long-term is smart, and particularly smart that he's using his Roth from a financial planning perspective, because if you look at various studies, they show that when you retire, you should tap your taxable account first, then your traditional tax deferred, and then your Roth. So if you're going to do this type of investing for something that you don't need for 30 years, a Roth is a great place to do it.
Yeah.